My name is Tracy Burke, and welcome to Conrad Siegel's second quarter market update, where we'll talk about what's currently happening in the investment world. In a few moments, I will be joined by my colleague Catherine Azels, and together we'll take a look at the market, what it did during this last quarter, what we can expect moving forward, and what it all means for you. So let's get started by looking back with what happened in the markets in the first quarter of 2021. While it was a wild quarter in some respects, equity investors embraced risk on the optimism of a recovering economy and the hopes of a fading pandemic. The S&P 500 index increased just over 6% in the first quarter. Small cap stocks in the US had an even stronger quarter with a return of over 12%. Value style stocks outpaced growth style stocks during the quarter by a sizable margin, and international stocks had a respectable quarter as well. Catherine, let's jump over to bond markets now. Can you talk about what's been happening with bonds this year?
Sure. Thanks, Tracy. In the bond marketplace, interest rates rose considerably in the first quarter. The benchmark 10-year U.S. Treasury yield rose roughly 90 basis points at the beginning of the year to approximately 1.7% at the end of the quarter, which is the highest level since January 2020. This is good and bad. It's good because there's optimism about continued economic recovery, and those looking for interest from fixed income investments can get a higher yield. It's bad because there's concern about near-term higher inflation levels, and when yields spike, especially in a short period of time, the price of fixed income investments decline. In fact, the general bond benchmark in the US declined 3.37% in the first quarter due to rising yields and lower prices. Similar to predicting stock movements, though, it's nearly impossible to accurately predict interest rate movements, and important to focus on the long term. Bonds will always be an important part of a well-diversified investment portfolio, and you kind of want to think of those as the fruits and vegetables that contribute to a healthy diet of investing. There were also some wild moments during the first quarter. In January, retail investors using the Reddit app jumped into shares of companies like GameStop and AMC Entertainment, trying to derail short positions held by some large hedge funds. At its peak, GameStop was up over 1,000% for the year, but quickly retreated. Bitcoin also had strong movements in the first quarter, trading around 58,000 to close the quarter, up more than double where it finished 2020.
Now let's jump to what is currently driving the market. The first quarter also saw some additional fiscal stimulus injected into many Americans' cash flow. According to a recent survey by Bank of America, over half of the Americans receiving stimulus checks plan to save it, pay off debt, or invest it. Nonetheless, it will still put more money into pockets, and many economists hope for a spike in spending for the remainder of the year as a result of pent-up demand and hopes for a fading pandemic. Additional governmental spending could be happening with President Biden's multi-trillion-dollar infrastructure program. This plan targets not only vast infrastructure improvements, but also green energy, manufacturing, as well as housing. Another spending plan focusing on anti-poverty and education initiatives is also in the works. At the time of this recording, these plans are still being debated in Congress, but likely will be followed by tax law changes to pay for it. As we speak, investors continue to see reasons to be optimistic. While there are still headwinds on the COVID-19 pandemic, the vaccine rollout has accelerated and economists raised their expectations for a swift recovery, being reassured that the Federal Reserve will continue to hold interest rates near zero. Consumer confidence is also at the highest level in nearly 2 years.
And for our stat of the quarter, we're going to take a look at a chart from our friends at BlackRock. We mentioned earlier that smaller sized stocks have been outperforming their larger sized counterparts in the recent times. This chart focuses on the S&P 500 index, which is comprised of most of the 500 largest stocks in the United States. Even within this large cap index, you will see the performance in the first quarter has been linear by size. On the left, the five largest stocks in the index returned 3.8% for the quarter, while the smallest 400 stocks on the right averaged a 12.2% gain. While long-term trends show that smaller stocks outperform larger stocks, this is certainly not always the case. From 2017 through the midpoint of 2020, the opposite was actually true, with the largest company stocks winning the race. So what does this mean? Markets often don't react as expected in the short term, so don't try to chase recent past performance.
So we've all heard the phrase that past performance does not predict future results. But imagine driving down the highway in your car while looking behind you. That might not work out so well. However, as we look forward, there are mirrors so that we are aware of what is behind us. This is important with investing as well. While the past is important, we do not want to get caught up in chasing past performance. We often open up our investment reports and we look for which holding has performed the best most recently. We then wish that we had more money in that best performer, but hopefully we stopped short of moving more into it. Remember that the best investors buy low and sell high. Chasing past performance is usually the direct opposite. And on that note, Catherine, I'll transition things back over to you for any closing thoughts.
Thanks, Tracy, and thanks to all of you for tuning in to our quarterly market recap. We hope you learned something new today. Feel free to share your thoughts with us. And as always, let us know if you have any questions or how we can help you. One of our favorite sayings is don't make short-term decisions with long-term money. So maintaining a well-diversified portfolio and focusing on the long term is as important as always. Until next time, stay safe, stay well, and stay invested.